Three.
What's going on, Legacy Hack people all across the world? Yours truly, Mr. McCart, coming at you again. I have Jack actually on here with me. We're going to be talking about some cool stuff. Unfortunately, Kyle wasn't able to make it this time. He had some other obligations. I think he might be Jack, if I'm not mistaken. I mean, he's getting ready to have a baby, just like you. Like last month, you had a baby. Kyle's in the kind of in that window as well. Is that right, Jack?
Yes, he's getting to the home stretch, getting ready to welcome number two, baby girl.
Wow, baby girl. And that's funny. Yeah. Kyle is not in the home stretch. His wife is in the home stretch, but he's got to be ready to be right there to help
There you
out.
go.
Okay.
That's the right way of saying it.
Yeah. Hey, people that kind of follow us and are intrigued by what we talk about, again, guys, our whole purpose for this YouTube channel or podcast, ever how you're listening to this, whatever way, again, we're here to help kind of provide some education, some stories that we've either experienced ourselves personally or with a client, or even we've read about, whatever it is. We want to share that kind of information with you. And today we wanted to tackle something that I think could be somewhat a little bit what it might be a little seems like off the beaten path of talking about IBC and infinite banking and family banking, all those concepts we talk about traditionally on our channel. But this ties right into that same kind of thought process of legacy, all right? Preserving your wealth, being able to have your dollar make other baby dollars, or extending the life of whatever your runway is that you have of life, and having income for those things. Because I have to say this before we jump into the thing that you could actually. I've got a buddy of mine. I'll just kind of use this right here. He is. I think he's when I first started talking to him when I just got my policies, Jack, on myself, he got really kind of curious about this, and he's younger than me. I think he's at that time he probably was maybe about 38, 30, 38,
Mhm.
30, maybe about 39 years old. Okay. So he's about 4 or 5 years younger than me. But he told me that after the conversation he and I had, that he actually created an insurance policy for retirement purposes,
Hmm.
which is kind of wild to even think about. Okay. But today we want to kind of tackle that whole entire side of things of annuities, which is kind of a form of insurance. But I'm going to let Jack, because he is actually right now, as we speak, has taken a much deeper dive into this in the last, 60 to 90 days, and actually started seeing some success with it because the market has kind of changed a little bit. And, I think that annuities, I actually have an annuity myself. I actually have an annuity on all four of my kids, if
Hmm.
you can imagine that. And they're not like huge amounts of money, but they're growing and they're secure, and I can take advantage of those down the road. Um, but Jack, I want to kind of tee you up with talking about annuities, talking about how it kind of fits in this whole, world of family banking, infinite banking, and legacy. So take it away, Jack.
Yeah, that's great. Yeah, I think this conversation really starts, well, it's down the road when you probably get to age 50 plus, where an annuity often comes into it. And when you say annuity, I think there's six or seven different kinds of annuities. So you're probably talking about like just safe accumulation focused annuities for the most part. Um, but when we think about IBC, we're often getting that in place in a person's earning years, and then they're using that to buy a business, start a business, invest in real estate or other cash flow producing
Put a down payment
assets.
on a house or something like that, whatever it is.
Yeah,
Yeah.
exactly. And that IBC, either whole life IUL policy itself, will accumulate as you get older. But we aren't necessarily viewing that as like a primary vehicle to draw retirement income for. Often
Nope.
experts view that as a very good bond alternative or something that when you get to retirement post work years, acts as a volatility buffer, like a great thing to draw from when, let's say, market assets are experiencing a dip and we don't want to further draw those down by withdrawing from them at that time. Um, but annuities really come in when, yeah, you have a 401k, IRA that's accumulated and you're getting to a point of stopping working, or maybe you are selling some real estate or selling off your business and have a liquidity event. The question then becomes, okay, we've built up this much. How do we make this last for as long as we live now? And we really start encountering some variables with that are totally out of our control. Like, how long will we live? Medicine's getting better. People are, yeah, like living into their hundreds. And it's like, have we accounted for 40 years of potentially like not earning income as much, but just like drawing down what we've built up? So kind of like you said, annuities are sold by insurance carriers who are really dialed in with their mortality charts and how long people live, and they essentially insure against living too long. I've kind of specialized in what's called a fixed index annuity that can safely grow by tracking index like the S&P 500 up to 9 or 10%, but then have a 0% floor. Um, so they grow in a way that allows you to navigate if there's a big drop in the market. But then when you're ready to kind of turn on an income stream, the safe withdrawal rate, if all your money is invested in the stock market, they say is 3 to 4% when you account for inflation, volatility, all those things. So that means if you had $1 million built up, you could safely withdraw 30 to $40,000 a year and for sure not run out of money before you die if you live the next 30, 40 years. And that's like likely you could take a lot more than that. But with an annuity, the idea is, well, what if we carve out 400, 500,000 of that million and lock in a 7 to 9% lifetime guaranteed withdrawal rate? And those rates are high right now. That's kind of why we're talking about this. Like, same way mortgage rates were great in 2020 and 2021, annuity rates are historically good right now because of our elevated interest rate environment that we're in right now. And it just makes it a great time to lock in some high income that will last as long as you live. So that's kind of how it can fit in. Love to hear what questions come up as I describe
Yeah.
that,
So
Tyler.
I'm sitting there thinking, Jack, right now, because like I had a client of mine, I think he was 52, and I'm starting to work with him right now on actually setting up his, actually he's wanting to do more of that permanent life or permanent life insurance, IBC thing that we talk about right now. But kind of something you said, he said, Tyler, my biggest fear right now is that my money is going to run out.
Mm-hmm.
Okay. And so he's going to have more life, than he has money. And he wants to enjoy those years down the road. And, I'm right now thinking of actually some close family members of my own that are, because I'm 47. And so these family members are definitely older in age, 60 and beyond. And one of them actually is getting ready to retire from his job that he's been there. And I took this out. This gentleman has been at the same job or same company, let me put it that way, the same company for the last 45 years. Okay.
Whoa.
Isn't that, Jack, isn't that wild to be able to say someone has actually been in the same company? He started out actually on the, I think, manufacturing line, and he's worked his way up to actually where now he's designing all the training for all the salespeople to go out and try to go sell to all the different dealers that they deal with. Anyway, this gentleman's getting ready to retire, and all his money right now is tied up actually in the stock market,
Mm-hmm.
so to speak. And he knows he and his wife want to have a comfortable retirement. But he's a little nervous because if the market does take a nice dip, he is very kind of nervous about that because when the market takes a dip, obviously that means his money goes down in value,
Hmm.
uh, and he doesn't have that much to draw on. I mean, what if you're sitting across from somebody like that, Jack, that's not in debt, that has done very well with their finances, and does have a let's just say that he's got close to $1 million, kind of in the market type thing. I don't know if it's if it's just regular stock or it might be like a 401k or whatever it is. What would you say to that individual that might be kind of in that over that range of 65, getting ready to retire? What would you talk to? How would you talk to that person?
Yeah, wow, you just queued me up perfectly because I'm gonna actually share my screen here for a sec.
Oh,
Because
perfect.
those are very real fears, uncertainties that yeah, that we encounter when we once we get to that retirement phase. I have two different scenarios here, Mrs. Green and Mrs. Red. They're the exact scenario said, both 65, both have $1 million account balances. They're both going to take 5% annual withdrawals from these accounts. And in both these scenarios, the average annual return is 6%. But you see some very different outcomes here because the returns are actually flipped. And Mrs. Red encounters 3 negative years in a row right when she retires.
Hmm.
A little like 2020 or 2000 to 2002, we had like that dot-com bubble and some down years. And you see, as she's drawing down 150,000 and also losing money in the market, all of a sudden she's got half of what she started with 3 years into retirement. And even though she has some positive years later, they weren't enough to recover, and she ran out of money at age 83. Um, on the flip side, Mrs.
Wow.
Green is, yeah, touching almost 4 million, and then hitting those negative years and is down to 2.5 million, but very different reality just because of what they call the sequence of returns that happened right when they started retiring. So yeah, with your buddy, like we need to solve for that risk because we don't want to, we don't want this to even be a possibility. Um, so kind of how I work with people, here's another little scenario of having $1 million. Let's say this person has $70,000 a year of basic expenses that they want to have covered, and then another 25,000 a year they would like to spend. Um, Social Security covers 30 of that. Maybe there's not many pensions left, but if your buddy worked for 45 years at the same place, maybe they'd have a pension that supplements that as well. But this gets them to 42,000, and that means there's still 28,000 a year, kind of like income gap. So what we can do to cover those baseline expenses with streams that will last as long as he lives is roll 400,000 of his $1 million account balance into a fixed index annuity that has a lifetime income rider. And if that pays out at 7%, a lifetime withdrawal rate, you have that gap covered. And then you have another 600,000 that can draw from for those discretionary expense needs, whether that's travel or gifts to children or otherwise. And you're set up now to just feel better about where you're at. And then last one I'll share, when you kind of think about, well, how do I like get money in different buckets that really take care of things for me? So cash, having that in high yield savings, or for us, cash value life insurance, is a great play so that like when you have scenarios like this, what if Mrs. Red didn't have to take 50,000 and she took a tax-free policy loan,
Yeah.
and then got to these years and actually like allowed her account to recover more because she hadn't been drawing it down further.
Yeah.
Um, and then those, yeah, what are the guaranteed income streams that can cover your needs? We'll call those paychecks, and then play checks are, yeah, the kind of the fun money that you'd like to have. That could come from distributions from 401k, IRA, real estate investment income, whether that's rental income or from syndication or debt fund. And then ultimately, what we want to leave behind is a tax-free death benefit, and then real estate and brokerage accounts, because those both receive a step up in basis, meaning when your kids inherit those, they inherit it at the current $500,000 valuation rather than the 100,000 that you bought it at. So they don't have to pay as great of taxes.
Yeah, I can actually speak with all authority with that right there as far as the real estate and brokerage accounts, because, my own uh, father passed away about 5 years ago. And, the step up is in basis really because he has some real estate brokerage accounts. And you're right, because he had bought those or had those securities done maybe 10, 15 years before. uh, it didn't affect me and my sisters whenever that actually happened, that event
Mm-hmm.
happened. And even with the real estate too. So that's a great point right there. And I like Jack what you talk about. If you go back to the prior slide of being able to kind of still keep you kind of splitting the difference. We're not taking everything. That $600,000 is still staying in play,
Mm-hmm.
as discretionary income and so forth. And I guess that would be, from like a brokerage account or something set aside that's going to be paying out, that amount of money. Um, but the annuity side, I guess a question I'd have for that 400,000 that maybe one of our viewers or listeners have is, you know, am I? How long can I for that annuity? Like that one couple we're talking about, he's getting ready to retire. Do I have to leave that in there, a certain period of time before I touch it, or do I have access to that, immediately, or how does that work, Jack?
Yeah, that's a great question. I actually have a client who just started one of these annuities, and um, 30 days from issuing it, she'll get her first monthly paycheck from that guaranteed lifetime income stream. So you can turn
Wow,
it on within 30 days. You could also wait 10, 20 years if you started it like in your 40s and wanted to really let it run up more. Because every year that you wait, the guaranteed lifetime income stream will jump up, because a lot of the products we use, the income benefit base has a guaranteed roll up rate of 7 or 8% for the first 10 years. Um,
wow,
so you can almost, yeah, you can have, like, if you put 500,000 in, that almost doubles. I think you get in the 900,000s 10 years from now. And that means you're getting 7, 8% off 900,000 rather than 500,000. So yeah, at the time that I look at putting these in place, it can be right when someone retires, but really like the 5 years leading up to retirement, that's a vulnerable time too. Because if an '08 or a 2020 happens, like right as you're planning to retire, and you're like, oh, now I have 60% of what I thought I was going to have heading into this, you might need to work a few more years. So really
right.
carving out a portion ahead of time that can't lose in the market, um, is a wise move to set yourself up.
And as far as tax wise, Jack, how does that work within the
Yeah.
taxes? Um, is there a way to you know do a pre-tax, like kind of how I think it's a Roth IRA or no traditional IRA works, or how does that work with annuities?
Yeah.
The
Yeah. Good
taxes
question.
after.
So like if you have a 401k or IRA, you can do a rollover into the annuity that will also have that same qualified IRA classification. So any money that comes from that as income is taxed at ordinary income rates. If it's a Roth, you'll be able to draw from it income tax free because it's post tax. And then you could also fund a non-qualified annuity with a bank or brokerage account, and with that, your principal is can be taken out tax free. But any gains from that are taxable. So, yeah, just depends on what you fund the annuity with. It'll keep the same tax classification as whatever account you funded it with.
I love this because I mean, Jack, I'm going to be seeing these individuals
Yeah.
actually in about 2 days. Okay.
Wow.
Um, and this is extremely timely. Just for my own edification of understanding annuities and, because again, there's almost so much my brain can absorb and just even understand the whole, you know, family banking thing is a ongoing thing. But even this right here is such a good thing to have in your back pocket to be able to help somebody, you know, I guess extend out their money even further that, acts like an insurance policy that, but it just
Mm-hmm.
is something that just kind of extends it out even further that you can draw upon, it really kind of what you're talking about at any time,
Mm-hmm.
when you're ready. Um, and I love that. So Jack, just kind of wrapping down with things, and putting a bow as far as I did want to ask this, Jack. So let's say this might be a good question for the listener, for the viewer. So when it comes to like, let's say, hey, I've been drawing upon my annuity for, 10 years. I was 70 years old. At 80 years old, I do actually graduate and go on to be with Jesus. Okay. And there's money in that annuity. All right. What happens to that money for, say, said heir
Mm-hmm.
of that? How does that work?
Yeah. Yeah, that's a good question because I think most people, when they think about annuities, they often have like the single premium immediate annuity in their head, which is like fund it and then you can never access that money again outside of the income stream that it provides. With a fixed index annuity, though, you have an account value that will grow by, like I said earlier, tracking a market index like the S&P 500 up to, let's say, 9 or 10%. And if you've only been drawn down 10 years on it, income wise, you more than likely still have account value that's available. And yeah, so there's technically a death benefit on fixed index annuities. And yeah, that gets paid out to a beneficiary upon your passing. It's not a tax-free death benefit like it is with life insurance. It'll, yeah, if it's an IRA, it will go to that beneficiary as an inherited IRA that they have to draw down within 10 years, and they'll pay ordinary income taxes on it at their tax rates. So again, like a non-qualified annuity would be received more tax favorably by a beneficiary. I like putting qualified plans into annuities and hopefully drawing those down to zero so that you maxed the income out that you could receive from it and leave more valuable assets to heirs. So that's kind of my preference, is to put those 401ks, IRAs that are really tabbed as retirement accounts into the annuity and keep brokerage accounts outside, if possible.
Jack, I'm gonna have to steal your presentation, buddy, that you got there set up because
Happy
this
to
is
send
really
it
good.
over.
Uh, I mean, you know, uh, I appreciate you sharing this. It's just again, it's education to me. I know that to our audience, it's also education. And you know, I would if you're a viewer out here, you know, you've got Jack that can definitely help you out. He's probably way more knowledgeable today on being able to help you out with annuities. Even though I know Mr. McCard and Kyle, we can help you out too. We just might have to rely on Jack to kind of help us a little bit with that. But Jack, and just kind of closing things up, again, I really like this a lot. The reason why I like it, Jack, is because of the theme. And, yeah, I know we want to primarily talk, family banking, infinite banking, private banking, on this channel. But, I think that, just kind of have a little bit of a broader brushstroke of legacy and legacy planning out there is kind of a little bit of, really kind of what we were after with this whole channel. And I want to flip it back to you to kind of wrap things up, put a bow on it, and we'll be done. So, what kind of closing thoughts you got, Jack?
Yeah, I think I'd just say like different times of life require different tools. The strategies you use to do well and earn and build wealth aren't the same tools that you need to live off of it and to leave a legacy. I think whole life policies, IULs for infinite banking are unique in that they're really lifelong tools that are intended to leave a death benefit and have all these living benefits along the way. But um, like you don't keep saving into a 401k once you retire. Like you're drawing that down. So maximizing what you can get from it through an annuity is a wise thing to do. So I think we need to be lifelong learners. Every season requires different tools and people to look to as teachers who can equip us with what we need. So I've been doing this for probably almost 3 years now, but really like leaning in now and um, seeing that there's some really great people serving in this space and hope to be that person on the unbridled wealth team as we are very much IBC focused, which I think these are super complementary as we've talked about. So thanks for being willing to entertain this with me, Tyler.
No, man, it's again, it's so people that are our audience to you guys, we kind of have a text thread that we kind of brainstorm a little bit of what we're wanting to talk about, before we get on here and just hit record and, go at it. And one of the questions that one of the topics was posed, actually Kyle actually posed it was being able to look at this whole annuity thing that what Jack's kind of uncovered. And I was a little hesitant. Yours truly, Mr. McCart, I was a little hesitant. I'm going to go ahead and admit it. All right, because I wanted to be pure still but as I thought about it, like we talked about, Jack, is this is there's every like I like the analogy that there are tools in your toolbox for financial things that you need to know about and be aware of, and you need to be able to take advantage of those things as you continue going through life. And the annuity is one of those things that is a arsenal in the tool belt if you can take advantage of it, to take advantage of it. And I love that about that. So without further ado, Jack, we're going to wrap this thing up and call it a day. If you want to get in touch with us, guys, you can always reach out to us on our LinkedIn. No, excuse me, LinkedIn. What am I saying? Calendly schedulers that's down below. If you want to have any further conversations about IBC, about family banking, about annuities, or any kind of just even legacy planning period of being able to help keep your money together, we'd be more than happy to talk to you. So without further ado, we'll call it a wrap.
Thanks, Tyler. See you guys.